tax planning, in my opinion, is understanding the tax code and the various loopholes that may or may not be available to you to help you lower your overall tax bill. Welcome to How to Retire on Time, a show that answers your retirement questions. Say goodbye to that oversimplified advice you've heard hundreds of times. This show's all about the nitty-gritty. Now, that said, remember, it's just a show, not financial advice. It's educational. So do your research. As always, text your questions to 913-363-1234. Again, 913-363-1234. Let's dive in. David, what do we got?
Hey, Mike, can you explain what tax planning is? Everyone talks about it, but then recommends IRA to Roth conversions.
First off, let's just dispel the IRA to Roth conversion bit.
Okay.
It's not essential for everyone to do.
Okay.
Some people have a sufficient amount of assets elsewhere that the IRA is maybe a third, maybe a half of their overall portfolio. And if they just focused on generating their income through their IRA, that their RMD is a part of their already expected income anyway. So do you really want to do IRA to Roth conversions? And if so, what's the benefit later on? See, people want the 0% tax bracket.
Yeah.
Well, that's nice, but how much does it cost to get there? Are you willing to pay, 20-some% in taxes, in federal taxes at the federal tax rate so that you can maintain a 0% tax bracket? Or would you rather then just take income for life at the 10 to 12% tax bracket while you're utilizing the standard deduction, the senior deduction, and the one big beautiful bill deduction? So assuming that tax planning's IRA to Roth conversions, yes, this is an oversimplification, and yes, it's not right for everyone. Everyone's different. Your plan's different, your projections are different, your strategies should be different. But that's just the tip of the iceberg when it comes to tax planning, for what it's worth.
Okay.
And did I hit that hard enough? That there's more to life than IRA to Roth conversions?
Yeah. Why is it so prevalent? Why is everybody talking about it? Is it just because we have it ingrained in our mind, like, ooh, Roth is tax-free growth. I'm going to do whatever I can to get there.
Yeah, I was talking with the CPA the other day, and he made a really good point. He says, your IRA to Roth conversion opinion changed this year. I said, yes, it did. Because the tax brackets, the percentages were supposed to increase at the end of the year, and the tax dollar thresholds were supposed to decrease at the end of the year. In other words, your taxes were going to increase in two different ways. So it made sense to maximize higher tax brackets now because overall your tax bill is expected to increase.
Okay.
And then the one big beautiful bill comes into play. Ooh.
All right.
Trump comes in, and whether you like him or not, I don't care. Whether you think this is good for the economy or not, I don't care. Well, here's what happened. Your taxes were maintained.
Oh.
They're not going up. So maybe that increases the deficit. Maybe supply chain economics solves the issue. No one really knows what will happen, but your taxes got locked in at a lower rate, allegedly made permanent, but tax code's really written in pencil. So there you go. But yeah, your opinion on will taxes be greater in the future that's an opinion. No one knows the future.
Yeah.
So you are making educated assumptions on what you think will happen and then proceeding as such, because you can't actually plan for the future. You can plan around the different variables for the future. Talk about, meta or existential right there.
Yeah.
And people say, oh, well, the U.S. debt's really, really high, so taxes have to go up. Just remember that solving the deficit, which, by the way, the deficit's different than the debt. The deficit is spending too much every year, which adds to the debt. The debt's its own thing.
Yeah.
They can solve debt in other ways. They could inflate it away. They could pay it down if they do solve the deficit or the overspending, which then would help out with. There's more than one way to solve these issues. It's not just increasing taxes.
Yeah. That would just be one out of all the strategies. That's one option.
Yeah.
Which they're not going to do.
Growing the economy is another option.
Yeah.
And maybe AI contributes to the growth of the economy. Maybe it doesn't. I'm trying to be neutral about all these things instead of trying to be prophetic. I'm not a prophet. No. So sorry. Got a crystal ball here. Yeah. It doesn't do anything.
I don't know if it works.
But sorry, going back to, okay, so tax planning. What in the
Yeah.
world is tax
What
planning?
is
Let's really, tax planning, in my opinion, is understanding the tax code and the various loopholes that may or may not be available to you to help you lower your overall tax bill. So when Warren Buffett says, I pay less in taxes than my assistant,
Yeah.
what he's really saying is he makes like a 100K salary is what he makes. So maybe his assistant makes more than that, but he's operating mostly off of long-term capital gains. What's that? The first 96,000 or so is taxed at the 0% tax rate as long as there's no ordinary income. That's a tricky part
Yeah.
because it means you don't take any ordinary income. IRA to Roth conversions shows up as ordinary income.
Okay.
IRA distributions shows up as ordinary income. Social Security pensions, they show up as ordinary income. Your dividends, if it's not structured correctly, shows up as ordinary dividends or ordinary income.
Okay.
So there's all these things that could get in the way that maybe you can, maybe you can't utilize the 0% tax bracket, but maybe you utilize the 15% tax bracket for long-term capital gains. Understanding what you can give and what you can take as you manipulate how you're going to generate income in retirement, that's tax planning. It's understanding the difference between 2A, which affects your modified adjusted gross income that's showing up there, and your 2B. Maybe you've got some interest that's being taxed because you're holding too much in cash. And if you're holding too much in cash, does the interest push you over a threshold that then triggers IRMA or not?
2A and 2B are lines on the 1040.
On the 1040, yeah.
Okay.
And does that put you $1 over on the IRMA? Because that could cost you an extra $100, $200 a month just because you held too much in cash with everything else that was going on. Tax planning also needs to be coordinated with your investment advisor and your CPA or enrolled agent or tax professional. Because if you've got someone over here trading your brokerage account and they have great growth, but they create too many capital gain issues, that affects your modified adjusted gross income and other parts of your 1040, which then push you into other situations that may not be favorable. So tax planning isn't just saying, hey, CPA, here, what happened? Well, here's where you pay your taxes. Good luck next year.
Yeah.
That's not tax planning. And tax planning is not saying, all right, well, we're going to do some IRA to Roth conversions. Here's the tax bracket. Let's just make this work. Forget about all the other unintended consequences. It's not about maximizing your ordinary income brackets. You need to acknowledge the other parts of your 1040. What's going on line 7? Or, so I'll just kind of go through, Schedule D, you got Schedule C. So do you have a side business? Do you have a business? Are you a 1099 contractor? Do you have, what's going on there? Are there short-term capital gains? Are there long-term capital gains? What's the cash flow look like? And is that going in the right direction? Too many times I've had people say, hey, let's do some tax planning. I say, great. The first thing we're going to talk about is line 3A and 3B. Because you're trying to get a lot of dividends in here. You're reinvesting the dividends. This number is going to get bigger every single year, which is going to get in the way of other things. Do you want to start spending this income? Well, but I need to do my IRA to Roth conversions. That's true. So what if we sold some of these positions? Yeah, this year we might have a difficult tax bill, but we can move it over to other positions that then don't create ordinary dividends. Maybe we buy specific stocks, and now it's a qualified dividend because we're holding it for the correct duration of time, and now we're getting taxed at long-term capital gains instead of the dividends, and we're matching roughly what the actual dividend target payout would be. These are things that are not talked about at all, because how many people pull up their 1040 and then they pull up their statements and then compare the two? It doesn't happen.
Yeah, statements like from financial statements, IRA statements.
Yeah, if someone has a brokerage account, I'm looking at their 1040 and their statements next to each other. And then saying, okay, so here's your positions here. That's probably what's contributing here. Let's take a 6 or 7% expected dividend on here. Okay, that's kind of how much we're getting right here. Got it. And then we're adjusting along the way. Right? So that's a conversation that's not really happening. Are you a business owner? Do you want an encore career? Maybe you're an executive or just a really smart person. You've got all these skills and you're going, I'd like to keep working, but not as much. Maybe I want to be a consultant or something on the side. Great. Now we're looking at line 12. Line 12 is where you got your deductions, you got your write-offs and so on. You got to be careful because there are certain things you can write off. There are certain things you can't write off. But do you see how tax planning is one part understanding your investments, one part understanding your cash flow. And cash flow is not income. Cash flow is the movement of cash in and out of your investments and accounts.
Okay.
So you can have tax inefficient cash flow that's trying to grow your portfolio, but you're creating tax issues along the way.
And so what's an example of some cash flow? Is that like a position paying a dividend and then the cash?
Yeah, your tax on your dividends being reinvested or spent. Is
Oh.
that efficient? Or if you've got rental income, okay, you've got rental income coming in. Do you have, is it efficient? Are you writing too much off? Are you getting a reasonable cash flow or income from that point? So it's understanding the flow of money through your accounts and the tax consequences that are being triggered in every bit of movement. And if I can go a step further, are you getting a good amount of return from your money? So some people are dividend investors, which is wonderful. It's one of the 10 strategies that work when it comes to retirement income, but they're getting like 2% from their dividend because they haven't really done the research on appropriate dividend stock or investments. A lot out there. So it's a highly nuanced conversation that doesn't start and stop with IRA to Roth conversions.
Okay.
So
it sounds like tax planning is, if I can put it in a nutshell, you're trying to be proactive and not like reacting every year.
yeah.
You're being proactive with, if I do this, then this sets me up in a certain way.
Right now, we're doing our year-end tax planning for our clients for next year's income. So we're anticipating by holding these positions, you're probably going to get around this much in your dividends. This much will probably be taxed as ordinary income, and this one will be probably qualified dividend. But what if we shift this around? What if we take this much and do an IRA to Roth conversion? We're going to be within this bracket, but your standard deductions over here. We are proactively assuming next year, and the things that we can do can save. I mean, no, it's not guaranteed for everyone, but thousands of dollars.
Okay.
There's one guy we were looking at who's got a side business, and it's just an LLC. I said, I won't say his name, so we'll say David, because you're right here, and I can say your name. David, your LLC, it's just pass-through taxation. This doesn't make sense. Let's have you file as an S-Corp. We're going to have your income, this much being now taxed as income, so you're going to pay FICA tax on this and so on, and then the rest is going to be profit. And because you want your kids to help out, we're also going to have them as employees a part of here. Here's how we're going to structure that. So that lowers your overall income, and you're getting your assets to the kids. That saved him, I think it was like $7,000 to $10,000, just in that one little adjustment right there.
Yeah,
that's net of all of the other burdens of the bookkeeping and things like that he'd have to sign up for because he has to manage things slightly differently in that situation. He was more than happy to do that, and that was also fun. This isn't tax planning; this is more legacy planning. But we then were able to structure so his kids were able to be employees of his side business. Now they're able to contribute to a Roth, and they're actually helping him out. It's a legitimate like employee situation, right?
Okay.
So now they're going to be funding their Roths at the ripe age of 16 and 17 years old. And if they just put it in high growth vehicles, just by funding the 16, 17, and 18-year-old Roth contributions, probably half his retirement has already been paid for before he even starts college.
Wow. Yeah.
So there is so much that can be done when you stop looking at, hey, let's just pick out your stocks and grow your money. And you take a step back and you look at the whole picture.
Right.
And a lot of that is tax planning. These are things that are not commonly talked about because a lot of people will have in their disclosures, we can't offer you tax advice. We can't talk about taxes. We can help you with IRA to Roth conversions, but that's kind of the limit of our scope. It's hard, in my opinion, to give investment advice without acknowledging the tax consequences. Yeah, how about that, huh?
Let that sink in. Yeah, it seems like it should be a no-brainer, right? Well, of course, taxes and your wealth planning and management and retirement should go together. It should be considered together, but often it's not, you're saying.
Well, imagine trying to bake a cake with half the recipe and the rest of it you just got to guess. Have you ever tried to let's say you have the ingredients for all the wet ingredients, okay? but you're not really sure exactly how much flour, so you kind of keep adding it until you think it's the right texture.
Right.
And you're not really sure about the baking soda or the baking powder, so you're just kind of guessing it. And then you put it in there, and it's like a brick.
Yeah. So you've guessed, and it didn't work out. It wasn't.
I did try once to bake a cake without a recipe. It did not go well.
Yeah.
Baking is very scientific.
It really is.
There's a reason why there's a recipe, but that's something you need to consider with taxes.
Yeah.
There's a reason for certain. You don't want to jump over dimes to pick up pennies. Here's another one I'll just throw out there as we kind of, I guess, end this segment. No one wants to pay taxes. I get that. But what's worse? Avoiding a potential tax bill and making adjustments to your portfolio positioned for the next environment for the financial markets, or just writing it out and seeing what happens. Because avoiding taxes could actually hurt you more than help you. Right? Avoiding taxes can cause you to get just nailed in a potential market crash. Avoiding taxes means you've given up your ability to make investment decisions or adjustments in your portfolio. So if you have no control, you have already determined the next 20 to 30 years of your life, and you have no willingness to adapt along the way. That's a risky thing to do. That's like, I don't know, saying, all right, we're going to drive straight for the next 70 miles on this road. You've got your car locked in. You're not going to change anything. You think it's going to go straight, but you can't see it because there's ups and downs along the way. Well, what if you need to turn, right? It's kind of a weird analogy, but does it make sense?
Yeah.
Sometimes it makes sense to just have a higher tax bill, maybe one every 3 years. And once every 3 years, you make a significant adjustment to your portfolio. You pay the tax bills, and yeah, you're getting hit by IRMA. But you're not getting hit by IRMA the other 2 years. You've got to have some sort of system, some sort of schedule that allows you to adjust along the way. You've got to make adjustments along the way. You don't want to buy and hold and close your eyes and hope it works out. Just remember, Cisco, the darling company of the 90s, crashed over 80% and took 24 years just to recover.
Whoa.
But they didn't pay taxes, those who didn't sell. So hopefully that illustrates my point. You don't want to just, get on the roller coaster, not put your safety belt on, and to hope it works out. You'll want to be prepared for the good, the bad, and the ugly. It's like when clients have charitable intent, I say, great, donate in January of one year and December of that same year, and then the following year, don't. It's really hard to get to exceed the standard deduction. But if you do all of your donations, all of your charitable gifting, you pile it up into the same year, but you just do it in January and in December of the same year, then you're able to probably write off part of it and actually benefit from it. So these are things to consider, but tax planning is much more than IRA to Roth conversions, though IRA to Roth conversions may be an appropriate part of your overall plan, and maybe you even start it earlier before 59 and a half if you understand what I mean there, and there's a lot of nuance. It's looking outside of just that strategy and looking at the other strategies, even to the extent of things like qualified opportunity zones, oil and gas partnerships. I know some people that have even used life insurance as a mechanism to utilize some tax efficiencies. Everyone's different, so be mindful of that.